his final letter to shareholders this year, Warren Buffett gave us all a timely piece of wisdom.
Don't beat yourself up over past mistakes, learn at least a little from them and move on.
And 2025 certainly delivered its share of lessons.
We saw Drone Shield and Boss Energy fall from grace, while CSL slipped under $200 for the first time in years.
And in the Magnificent Seven, leadership kept rotating. Microsoft to Nvidia to Google, each taking a turn in the AI spotlight.
It was a reminder how quickly things can change in markets. So we're asking the fundies, what did 2025 teach you, and how will that shape how you invest in 2026?
2025 was really about trimming some of our winners too early. So we had some companies where you'd started to see earnings growth improve and really different parts of the business start to fire on all cylinders. And we were probably guilty of trimming some of those positions early in the year. So if I think about a company like Eagers, they've had lots of things go right in 2025. We saw a cyclical trough in 2024 in the new car market. Their used car platform, Easy Auto 123, has been kicking real goals this year. Their partnership with BYD has delivered strong results. And now they've entered into the Canadian market in a really sensible and measured fashion. And so as a result, when you see considerable earnings growth for a business, you'll often see multiple expansion with that. And we've probably been guilty in companies like Eagers of potentially trimming that position too early. And it's an easy mistake to make because as the position is going well, it's becoming a bigger part of the portfolio, which means that the volatility performance becomes more dependent on the daily swings in these larger positions. But you just have to remember that when a company is doing well, it's very unlikely that you're going to see material share price deterioration in that sort of environment.
Look, one thing I've learned on the journey as an investor is there are three key variables that drive stock prices. Liquidity 1, earnings 2, and dividends 3. And it's really been watching liquidity on show this year that's taught me, well, it's reminded me more that investor interest is strong in certain pockets and nowhere stronger than in small caps, where daily turnovers in the Australian share market are strong and small cap turnovers are approximating about 20% of total turnover. A decade ago, small caps would account for 10%. And why is that? It's because there's a whole lot of money trying to find a warm spot. And that warm spot is small caps and mid caps, where there is superior earnings on show and superior earnings available for 26. You pay 20 times for both small and large industrial earnings. That's the PE for both those indices. For smalls, you'll pay 20 times and get 16% earnings per share growth in 26. If you go to mid caps, you'll pay 20 times and get 6%. So liquidity has found the warm spot, and that's earnings conviction.
The lesson is extrapolation and the risk of extrapolation. So because of that strength of the market in resources, technology, and for example, defence, the market got very excited about all those themes during 2025. And you can see already stocks like Templar Webster was down 30%, Drone Shield down 60%, and some resources stocks down 20 or 30%. So you can see like the market got excited about certain clusters of momentum, but when the stocks disappointed, the downside was quite large. So I think the risk is that you extrapolate the excitement of 25 through into 2026, but you've already seen some signs that you need to be careful about extrapolating that excitement about growth or momentum. So I think you need to watch the earnings and watch expectations where they are, because it was at a very high level during 2025. And leading into 26, I imagine after some pretty strong years, that extrapolation and enthusiasm is going to be tempered somewhat in 2026.
There were so many chapters of 2025. So maybe if we focus on the most recent history, in the last few months, we've seen a real change in market leadership. For the last few years, quality, growth, and momentum have been the names of the game. These are the factors that have outperformed every other factor. But that's changed in recent months. We've actually seen the likes of value and short interests come to the fore. Now, we believe that the market pendulum swung so far that one way towards growth and momentum, it could swing back a fair way over the months and the year ahead. So how do we position for that? We're looking for companies that are cyclical, with strong cash flows, dividends, and dare I say it, some value.
I think there's 3 things that we learned this year actually. So I'd say kind of adaptability, diversification, and of course the use of AI. On the first point of adaptability, there's obviously been lots of headlines. We talked about how we should let the headlines wash over us, but we should adapt our theses when it makes sense, when the facts change. And we did that this year, I think, pretty well. It was also helped by diversification. So you had things like geopolitical shocks, we had some idiosyncratic stock blow-ups, policy changes at the last minute, courtesy of Trump. These things are really hard to predict. And the best way to kind of fight them is to be diversified. So, we're pretty broad across countries, across sectors, across factors, you name it. And I think that diversification really helped us this year. And then, of course, it would be remiss of me not to mention that I think AI usage, particularly as it pertains to fundamental investment process, that really played out this year. And interestingly, we thought that was going to help with sort of the beginning parts of the journey, so things like idea generation and forming a quick view on the company. This year, we actually saw it go deeper into our investigative work, so that real fundamental analysis. AI really helped there. We actually have AI agents now who do 24/7 monitoring on every position in our portfolio. So that's been a major game changer. And those three things, adaptability, diversification, and use of AI, they're things we're going to double down on into 2026.
2025 was an interesting year because it kind of started off pretty hot and it was the same trend. Money was going into large cap, it was going into banks, it was going into tech and growth companies. And then suddenly it hit a brick wall and it all kind of sold off into April. And then there was a big rebound. But that rebound didn't hold. And what we've seen later in the year is we've seen a big switch into, I think, more valuation sensible type names. And that is obviously positive for us. And so there's been a big rotation. We're hoping that rotation continues. I guess what did I learn from that? I learned that there can be big shifts in the market and you can get really caught out if you don't have valuation discipline in what you do. So I think the fact that we do valuations for all our companies is really important, and also that they make sense.
Yeah, really good question. I mean, we have an investment process and we apply that. But again, it's about making sure you let those winners run, those compounders, and you don't jump off too early. And also where we make mistakes, that idea of cutting them early because, that's where the problems in the portfolio occur. So that's a continual focus of the fund. And I guess for me, it's also the world's starting to change pretty quickly. We've got to be across a number of new sectors and things. And, you've got to look at these opportunities and spend the time doing it. So making sure we've got an open mind and we're actually exploring some of these changes in consumer behaviour, technology, how things are evolving, and making sure that we're just not saying no to things because we don't understand.
Well, actually, it taught me that, sticking to your discipline and process is more important than ever. We saw markets somewhat driven by speculative forces in 2025. We saw kind of unprofitable tech and lower quality companies performing well off narrative. And I think what's really important is, as an investor, remembering what you do as part of your process and sticking through it, through that discipline, even when markets might be disagreeing with you for a little while. Because if your process is proven, it will outperform over the long term. So stick to your process. This is kind of the opposite to your question, right? This is actually, I learned that discipline and process is more important than ever.
The passive impact on markets is just becoming more and more significant. And the big lesson for us is to keep incorporating that into our process. We want to buy cheap stocks, so looking for things that are falling out the bottom of the index and getting all that passive selling is a great source of opportunities. And then on the upside, when you get something right, being really cognizant about where it is in that into the index or out of the index dynamic can really help you make more on the upside as well. So we've factored that into our process already and we'll be doing more of that in 2026.